Well, happy Monday, everybody. Colin Harper, Michael Kutch. We thought we'd kind of hop on this Monday, do a little quick live video about everything that's been going on as far as Silicon Valley Bank. And, we have one other institution involved as well. We've been already starting to get a handful of questions on it. So we wanted to do a quick video, address that. Before we get rolling, important disclosures. Nothing we say here should be taken as advice. These are our opinions on what we see going on. Nothing's meant as investment advice or specific recommendations for you. But I don't know, Mike, maybe we start talking about, how we got here and what happened to Silicon Valley Bank and how, they defaulted on all those withdrawals and what the government's reaction was to that. And I think we start there, talk about, is this something of a bigger story, or is this an isolated event? And I think there's some really interesting responses we saw from the government as well, how they stepped in, and we'll talk about that as well. But I guess let's start and just chat about how did we get here.
Yeah, well, I'm not a banking expert by any means, but I certainly know a lot more about how banks work now versus a few weeks ago.
I think Mike and I, the last couple of days have been taking a crash course on the banking system here. Absolutely.
Yeah. So Silicon Valley Bank is actually the third bank to fail this week, but it gains the most attention because it's the largest of the three. I think it was the 16th largest bank and has now become the second largest bank to fail. Mm-hmm. So basically, this is what happened. They got a ton of deposits during 2020 and 2021. And most of those were unsecured, about 85% of them. And what that means is they're above that 250,000 FDIC level. So they have most of their customer base is these tech startups, biotech startups. So all these deposits came in, and now they can classify them in one of two ways. Available for sale, which has to get marked to market, meaning if the values of what they invest in fluctuates, they have to mark that as such. The other category is held to maturity. And that was about 80%, I think, of their deposits.
Yeah, it was definitely a very heavy allocation in marked, for maturity, which means it's not really showing up on their balance sheet.
And they can kind of hide them. They can hide their losses.
And so the actual...
go ahead,
Mike. I was going to say, so the actual liquidity there was a lot less than what the actual, value of everything was a lot less than what it looked like, just because so much of it was kind of off not the books, but off of, just what you could see at a quick glance looking at that institution. And I think, especially catering to those startups too, as you mentioned, most banks have a significantly smaller portion of corporate money, we'll call it, versus, retail money. Most people have more of an even balance between, most banks have a more even balance between retail or those sub $250,000 accounts versus those over $250. And why that number is so important, and we'll touch on this a little bit, is any account at a bank that has $250,000 or less is covered by FDIC insurance. I'm sure a lot of you have heard that here, but that's a really important number, and we'll kind of circle back to that later. But sorry, Mike, go ahead and keep going.
So basically, they took those deposits, whichever category. If it's available for sale, they try to be a little more short maturity, so you don't have as big of interest rate risk. But a bulk of their assets or the deposits were invested in things like mortgage securities or treasuries, whether that's shorter end or 3-year, 10-year. And they did it at very low interest rates. So now they have big losses, especially on those held to maturity. Now, what happened was, since their client base is a lot of those tech startups, they've really had a tough time over the last year and a half. So they started seeing significant outflows from those deposits. And especially last week, I think they had like 40 billion outflows. And they don't have the assets and available for sale to cover that. So they tried to do a capital raise, I think I think it was Thursday, it might have been Friday, but they failed on that. So they pretty much were frozen all their assets. Now they can't really go into the long or the held to maturity ones, because if you sell one bond, I believe, out of the held to maturity, you have to market that whole book. So the losses that would appear would be much more substantial.
pretty astronomical losses, really. And that kind of their attempt to raise equity was kind of, I think the sharks smell blood in the water, right? I think there was a massive rush on from some of those larger depositors on Thursday and Friday, trying to get assets out of there, kind of seeing what was coming.
Yeah, because they know, I mean, most of that money was
Yeah.
unsecured over 250. So if there's a bank run, they don't know if they're getting that money back or
Oh,
not.
absolutely. Yeah, absolutely. So that's why, so those huge, so basically, then the government stepped in, kind of made a pause and, took over the distribution of funds out of that bank for the folks who wanted to get money out of the bank. So I guess we can kind of hop into that, but that's kind of what caused it. That's kind of the big thing. There's the investments due to rising interest rates, although they were good investments because they're not able to be held to maturity because they needed cash to fund all those withdrawals. They basically defaulted, right? They didn't have enough money available to send out.
Yeah, I mean that's pretty much what happened. The federal government got the FDIC to step in and say, even the portion above the 250,000 threshold will be available for withdrawals. So what they were trying to really do is prevent a big contagion effect where this starts bleeding into other banks. And I think at this point it's safe, but if you're concerned about any regional bank stock exposure you have, I would really look for those ones with higher levels of the unsecured. I think they're more prone to have these bank runs.
Yeah, another important thing, for folks listening here that, if your account has $250 or less in cash, you're covered by FDIC insurance no matter where you are. So you'll be made whole by the FDIC, if worst case scenario, something were to happen at wherever you bank, right? But I thought it was very interesting that the FDIC stepped in. And like you said, Mike, it was a very deliberate action that they stepped in and said, we're going to cover all these deposits. Because the last thing they want to see happen is this to become a chain reaction and start happening across banks all over the US here. That's kind of what they're trying to prevent by covering these losses, right? And I think, we're going to see some new rules and regulations based on bank balance sheet. Good news, bad news is first thing everybody thinks is it's 2008 all over again. The banking crisis is going to start right over again and everything's going down. We're going to be bad. So good news, bad news is we've been through that banking crisis before. And I think, we actually learned a lot of lessons from there, which is kind of one of the reasons I think we saw such quick, swift action by the FDIC trying to prevent this from spreading and hoping this is just a, specific incident on these couple of banks that we saw here. Another thing to mention too is that Silicon Valley Bank, certainly the biggest and the one that we're seeing the most impact from. And my mind is escaping. The other one we saw last week, Mike, do you remember the name off the top of your head? Because
that's Silvergate. And
Silvergate, thank you. Yeah,
their main customer base was that they're big in crypto, so that
exactly
kind of their collapse. So both of these are kind of very unique to those specific companies. So I don't think you're going to see like the broad effect in these other smaller regional banks. But what you could see is them kind of restrict the lending environment more because they are going to be dealing with these. They all have like the treasuries and stuff on their books that do have unrealized losses, whether they're classified as the available for sale or held to maturity. But unless you have a bank run or they face significant challenges from their customer base, I don't see a likely continuation like we saw this last week.
Yeah, I would agree. I mean, if we look at larger banks, they're generally a lot more diversified than Silicon Valley Bank was. A lot of those larger banks also didn't see the growth that Silicon Valley Bank saw. I mean, in the last 5 years, they quadrupled the amount of deposits, and that money had to go somewhere, and it went towards securities, right? So their balance sheet was a lot more concentrated than a lot of these larger banks. It was a bit less diversified. Not necessarily, they didn't have bad investments. Interest rates just ended up crushing them and they didn't have available capital. And because of that, the loan environment for those startups, continually got worse and worse and worse. So they needed to access the cash they had on hand, and it's kind of just a chain reaction there. Are we so as far as the U.S., we're not really seeing quite yet this trend continuing into other banks. I think if we're looking at the market here in broad senses, we won't talk about any individual companies or anything, but especially some of those regional banks are getting hammered today. We saw a bit of a jolt at the open of the market. I think we were at least trending in positive territory last time I took a peek at it. I think whenever we have big events like this, I think something that's really important to think about in the short term market movements often work off emotion, right? And, and that's something we need to take with the greatest shot. How much of this short-term movement is based on emotion? But what really I think affects it long term, is there any long-term economic damage? And that gives us a pretty clear indication on whether the short-term emotional swings will see a quick and speedy recovery from, or if there is long-term economic damage, that's generally leading us toward a path of maybe a more long-term recession. I mean, Mike, what do you think? Do you think we have do you think this has the potential to cause any long-term economic damage, or just more of the short-term emotional swings?
I think this is going to kind of just play into the economic slowdown that I feel we're in. It's more of a warning sign of what could come. Like I said, I think it'll probably constrict the lending from banks going forward. They're also getting some pressure to increase their deposit rates that they've been quite sticky at the low end. So that's also going to hurt their margins a little bit, that net interest income. But as we all know, housing's been very slow. Manufacturing's been very slow. It really hasn't seeped too much into retail spending yet, or certainly not into the employment situation. But once margins start to contract, that's when it hits the employment situation. It's usually a later leg to fall, the last leg to fall. So I'm very interested to see what this means for the Fed in a couple of weeks. Before all this happened, it was looking like they're going to, a pretty high likelihood they're going to do 50 basis points and another 2 after that, getting to, I think, 5.5 to 5.75. Now there's a chance they do 25 at this meeting, or maybe even a pause.
Absolutely. Well, another, I'm going to backtrack a little bit, because there's one interesting thing that stuck out to me that I think we forgot to mention, is that the FDIC's government entities actually went and created a fund as part of this package to kind of curb runs at banks. And that fund is intended to provide liquidity for banks in similar situations. And as collateral, they can take any investment grade security. But what's interesting is they'll take it at maturity value, not current value. So say, for example, this was available, and I have no idea if this would have actually stopped, what happened to Silicon Valley Bank. But say, for example, they had a big run on deposits at Silicon Valley Bank, and this fund was in place already. What Silicon Valley Bank could have done, in my understanding, is some of those assets that were in their hold to maturity bucket, they could have pledged those as collateral and actually taken out the maturity value to give to their depositors, versus diving in and having to start selling all those at a substantial loss. So I think that was a pretty important point, that was one other way they're going to try to curb the run on bank deposits here. And I thought that was a pretty interesting thing we forgot to mention. So I figured I'd bring that up. And and what the tone. So this is Mike, and you can correct me too, because Mike and I actually haven't talked about this much together. This is kind of our impromptu. We figured this was important. Let's get together, talk about it on a call. But the tone I'm getting from the Fed and FDIC, and the reaction to this is, we're very concerned about depositors. We're not nearly as concerned about, people in management positions at the bank or shareholders of bank stock. We're concerned about depositors and making sure that they're whole versus the other side of it. And I think that's certainly a good thing to see as a depositor on the retail side of it. And that and so that's kind of the tone I'm getting from them. Are you seeing the same thing, Mike? Any insights onto those couple of things?
No, that's spot on. I think Biden came out and said he plans to have them lay off all the top management, and they're not protecting the shareholder; they're just protecting the depositor and trying to prevent their contagion.
Well, the good news is I know the CEO of Silicon Valley Bank recently spoke on what he does in his downtime, and it was cycling. So I think he may have plenty of time for cycling in his future. And I obviously it's not a dig or a comment. I have no idea, if it was, how they got in this position, if it was directly related to his choices or someone else's, but just an interesting tidbit.
I can't believe the move we've seen in treasuries this past week.
And we've seen a substantial move. Certainly the biggest, one of the biggest, correct me if I'm wrong, is it the biggest in our career or second biggest since we started? Did we see similar moves back in 2008, or is this larger than what we saw back then?
The move in treasuries?
Yeah, move in treasuries.
Yeah, not quite that. I mean, the pace that it happened, I think the 2-year dropped about a full 1% in a week, and the 10-year has gone from a high of 408 down to just below 350 today, I believe. Yeah. So that's some bond volatility.
That's a ton of volatility. And, I think we don't talk about this very often, and it's a concept that seems fairly foreign to a lot of bond investors, but I'll talk about holding bonds till maturity. So bond prices are really inversely correlated with interest rates. So the longer the maturity of a bond, the more price sensitivity we're going to have. And if I say something stupid, Mike, just hop in and correct me. But but the longer maturity, the more price sensitive we have, right? So if we look on interest rates, and when they rise, generally bond prices are going to fall, especially the longer duration bonds we have. One interesting thing that people often don't think about is if we look at our portfolio and it's down, if we hold those bonds to maturity, we're going to get back our par value or what we originally paid for them. Effectively, earning whatever stated interest rate is on those bonds along the way. So we're going to be made whole again at the end of that holding period, as long as we hold those. And this only applies to actually owning individual bonds. So, for example, if you own individual bonds inside your portfolio and they're down 10%, if you hold it to maturity, you're going to be made whole, all the while having collected those interest rates along the way. So there's still a lot to be said for owning bonds, even with all the volatility we've been seeing there. Just know that the volatility isn't necessarily an indication of the safety of the asset class, especially when we're talking about government or, investment grade bonds. It's more of a reflection on interest rate environments than the actual underlying security, especially if we're planning to hold to maturity.
Yeah, exactly. You have to really look at, especially if you're on more of like the ETF or mutual fund side, you have to really look at what it's investing in and whether it's worth the longer maturity bonds. Because in a sense, before a week ago, a 2-year treasury looked very good at 5%, while the 10-year was closer to 4%. But what's going to happen in 2 years when you have to reinvest that? That's the reason why sometimes it pays to add a little longer duration. So I know, what was it, a few weeks ago, I was talking about starting to add some duration as the 10-year was creeping up above 3.75. And I did get some in. Obviously, at this point, I wish I got a little bit more in. But you do that because in times of financial distress, it usually pays off. And treasuries usually get a bid where people flood into them, like you saw today and Friday.
Yeah, absolutely. And I think that's a great point, Mike. I mean, a couple other things is I've gotten a couple questions, and not a ton, but I've gotten a couple questions, kind of as this news is broken about, money market and money market instruments. Is there any, concern there on, banks being able to meet those obligations? And I would say there's no concern there that I know of, right? I don't pretend to be, an expert or anything like that on the bank side of things. But as far as money markets goes, I don't see a nearly that same level of concern or anything that could happen there similar to what we're seeing now. That's kind of my opinion on the money market side of things. I think Do we want to chat about the EU and their reaction to this at all, Mike? Do you think that's kind of relevant to our conversation here, or leave that for another time?
Yeah, maybe leave it for
That's
another.
fair. Yeah, we can always hit on that on Friday if we want to. But I think, you know, just to sum that up really briefly, I think EU, especially smaller EU banks, are seeing a similar decline in stock price as the US is as well.
Yeah, I
So
think.
just to,
I mean, who was it in the fall? Was it Citigroup that saw big outflows over a couple of days? And
I believe it was, yeah.
but in an overall sense, with international, I mean, all of this should lead the dollar a little lower, especially if concerns of recession in the U.S. increase. So
Mm-hmm.
if the dollar falls, international stocks should do a little better from a U.S. investor relative basis.
Yeah, absolutely. So, I mean, to kind of recap all of this, I know we threw a bunch of stuff at you. Hopefully, you're able to follow along with some of our thoughts. What does this mean for you as an individual investor? Because that's, you know, most of the folks we work with. Um, if you have $250,000 or less in your bank account, realistically, it's a non-issue, right? Because FDIC insurance is there for this exact reason. Should something happen like a run on deposits at the bank, you know, and we've seen their commitment to that and them stepping up to the plate and even deciding to cover all deposits there, which I thought was a very strong move and an indication of, you know, we are fully invested in our banking system and have no you know, no plans for it to fail whatsoever. So take some solace in if you have 250,000 or less in your bank account, I think you're going to be just fine. You know, I think if you have more than that, spreading that out, I think is going to be certainly worthwhile, you know, across a couple of different institutions. So that's one thing. What we saw in Silicon Valley Bank was very much a result of their deposit base and asset base, right? So their deposit base, they had a very, very minimal number of branches, all, you know, around that Silicon Valley startup area. And assets, they had a ton of new deposits in the last 5 years, giving them a very concentrated position of accounts over 250,000. Larger banks were not as concerned with because they have significantly more diversification and larger capital as well. You know, that's just kind of a sum. So do we see this as a systemic problem and this is just the start? My answer as of right now is no. I mean, Mike, do you agree with that?
Yeah. But like I said, I think it could restrict lending going forward where these smaller banks start to be a little more careful.
Absolutely. I think we're going to see some added regulation and a tightening on lending as a result of this, which I certainly see that to be a probable outcome from this. But as far as should we press the panic button, I think the answer is no. Right? I think we know what we're dealing with. We know what caused it. We saw the government's response, and we know what that looks like. And now, you know, it's kind of our job to balance is this short-term emotion or is this long-term economic damage? And that will help guide, I know, Mike, that'll help guide a lot of your decisions going forward and how we're managing our clients' portfolios. But I think, you know, if you're just watching this for some thoughts, I would say, you know, form your own opinions, whether this is just short-term emotional damage or long-term economic damage. You know, kind of, if you look at the average investor, they like to get in when news is good and get out when news is bad. The only downside to that is you have to make two right decisions, right? You have to pick the correct time to get out and the correct time to get in. In general, our advice is always stick the course, stick to the plan, and you'll wind up, you know, where you need to be as long as that initial plan is solid and has been thought out. There's going to be storms to weather. You know, we'll see how big of a storm this ends up being. But I know we wanted to get on a quick call and just give some of our thoughts on it because we're getting a lot of questions on this already and certainly expect that to continue. Mike, that's all I have for just our quick little discussion on this. Anything you want to add before we sign off here?
Nope. Tomorrow should be another volatile day with CPI data coming out.
Yeah. So volatility is here to stay and has been for some time. So if, if any questions, feel free to reach out. We'd be happy to chat with you about your specific circumstances. But we will see you guys again on Friday at our normal Friday Live. Again, this is just a quick way for us to pop in and give some quick comments about what's going on. So hope you all have a fantastic week and look forward to seeing you again on Friday. Take care. Mike, thank you.
Yep. Bye.